All right, everyone, welcome to Macro Race with your host, Tony. Today, we're going to be going through EIA inventories. Just to bear in mind, the EIA have said themselves that the data could be delayed. There was no indication of the timing or any update to the timings from them. But I think it's still useful to kind of go through the EIA inventories, what the release is, and how it affects the market, some of the sentiment that is surrounding the crude oil markets at the moment. So we'll go through that, and we'll try and keep an eye out for any sort of updates to the potential potential EI inventories release. But let's go from the beginning then. We don't have too much sentiment to kind of go through with the oil market, so it's nice and easy this week instead. So what is the release first? That's what we've got to understand. So what it represents is the weekly change in crude, gas, and distillate inventories, and the areas that are affected the most within the economy when we're talking about oil in general. When oil prices rise or fall, transportation is affected the most, of course, with supply chain issues or delays to goods being delivered to certain areas within a country, or to businesses that require those goods to make or sell onto consumers. And in turn, that can also oil can also affect the consumer prices, as well as, of course, we've seen with fuel and natural gas prices. That's had an impact on inflation readings that we've seen recently, and was what had led the Federal Reserve to one of the key reasons as to why the Federal Reserve had seen the headline inflation reading being much higher than expected, and inflation being quite strong, leading them to do a 75 basis point hike rather than doing a 50 at their previous meeting that they had. So oil can have an effect on a number of consumer goods, and also services as well. Don't forget when you're at the so if we carry on, then we're looking at other bits and other things to be aware of. So why is it a release to watch? Well, it can be a very volatile release. The reason being is that the oil trade in the past, before the Ukraine-Russia conflict, sometimes you could see moves for about $1 or maybe even up to $2, depending on how strong the data is, or how big the deviation is, whichever direction it goes, whether there's a build in inventories or whether there's a draw in inventories. But recently, we haven't seen that much volatility or those spikes from the crude oil inventories release itself. The main reason being is because there have been other headwinds that have affected crude oil prices. Of course, the Ukraine-Russia conflict, China's COVID lockdowns and easings, OPEC and what they've been doing to kind of jump in to supply energy to the markets to kind of take over Russian production in a way, or loss of Russian production of crude oil and other energies as well. So that's one thing to consider, is that volatility, it has kind of waned, but still is a release to keep an eye out for, and can be volatile, or is known to be quite volatile. Also, how does it affect the market? Since this is key for everyone to understand and know, is that when more oil is added, it's negative for oil, or when there is a build in inventories. So you've got to think about supply and demand. When more oil is added, but there's less demand, the price of oil tends to go down. And on the flip side, when there is less oil added, or when there is a draw in inventories, it's more positive oil. So when there is less oil available and there is a higher demand, then that can boost the price of crude oil in the markets. And hence, when you get the release, if it does show a draw or a big draw, then you see an appreciation in WTI crude oil, most notably. But that's just a key thing to understand when you're thinking about the oil markets, and how the release, or how the markets react to the release itself. Okay, so the triggers then. So according to economists, so they see a high estimate of 2.4 million with a low of minus 3.5 million. Gasoline with a high of 1.1 million with a low of minus 2 million. Distillate with a high of 1.7 million with a low of minus 2 million. Also, bearing in mind, if you are watching this now, and if you are finding useful so far, and hopefully you still find it useful throughout the video. Don't forget to share this video with your friends, your other traders, or your group of people who maybe trade crude oil inventories or have a focus on in commodities. Share this video with them. Help give us some support as well. That'd be very appreciated if you could do that. As said, if you like it and you find it useful so far, and if you found my content useful in the past, then do definitely share the link with people and spread the word of macro-ace. Active Imelda says, I love this channel a lot, really helpful. Wish we can do it daily, even on risk sentiments. Although there is a video that I did, a webinar about what does risk on, risk off mean. I'll post that in the link after I've done the EI inventories prep, and we've seen hopefully if we get the release today at 11 a.m. Eastern time. So other things to consider then, I just also want to make note as well. So the forecast or the median estimate then for crude oil inventories is to show a draw of minus 1.5 million, prior of 1.956 million. The gasoline inventories also expected to see a slight build to minus 0.65 million compared to the prior of minus 0.71 million. And distillate inventories is expected to show a draw of minus 0.25 million compared to the prior of 0.725 million. So median estimates, if we're looking deviation wise, then so economists at the high end that they're looking for about 4 million or about 4 million deviation on the headline figure itself for crude oil inventories to get to this high point to what the current estimate median estimate is. So that's going to be quite key, I think, for us as well. We've kind of stuck at around 5 million of a deviation for ourselves when we're expecting the figures when they come out. Other things to be aware of then. So we had API data last night. API crude oil stock change showed a build of 5.607 million compared to the forecast of minus 1.433 million and a prior of 0.736 million. So one thing to know with API data is that API data has been used as a way to trade the release, and also to foreshadow what the EI inventories data itself could be as well. Now, there hasn't been a strong correlation to say if API data the night before shows an overall build or draw, that the EI inventories data itself the following day is going to show the same thing or move in the same direction. But for traders, they do try and foreshadow, okay, if they do trade API data, that they try to price in what EI inventories data the day after could be. Although API data used to be a trade that you could actually trade off of, because there wasn't any extra volatility surrounding the bit of news, i.e. other sentiment of Ukraine, Russia, China, and OPEC, and also the central bank tightening as well that we've seen recently. We've seen quite a lot from different central banks and all the major central banks. But API data usually was something that you could trade and get a reaction from, but we haven't seen that since the Ukraine-Russia conflict. So we had API gasoline stock change, which had shown 1.216 million compared to the prior of minus 2.159 million. And distillate stock change actual was minus 1.656 million compared to the prior of 0.234 million. So overall, we'd seen a build in private data that we had seen from the American Petroleum Institute that provides this data privately. So the data isn't released bang on at 4:30 p.m. Eastern time all the time. But as said, still something that traders keep in the back of their minds when they're trading the EI inventories release as to which direction it could go. But as said, there's not a very strong correlation with that. Doesn't always mean that you're going to see the same direction the following day. Active Imelda says, no, I've watched it actually. I just meant on updates of day. Oh, okay. Daily sentiments in terms of what things to expect when we're in risk on risk off environment from high beta or safe haven perspective. Okay. Yeah. That is something that I'll consider and could potentially work on. But okay. That's, hopefully you found that video useful, as well. The risk on risk off video. As well, to kind of give you a basic idea of what to kind of expect. All right, so we've got about 20 minutes or so. Again, as said, the data it might not come out at 11 or it might not come out at all. But as I said, it's still important to kind of go through sentiment with you. So talking about sentiment then, what's moving the oil markets at the moment? So at the moment, we can currently see that WTI is up by around 1% or 1.1% on the day from what we can see so far. But one of the things that is moving or driving sentiment at the moment in the entire market is fears of a recession. Okay, so recently we've had, of course, with the Federal Reserve, that when they took their last rate decision to hike by 75 basis points. So their main goal is that if they see that inflation is getting out of hand, okay, then they will do whatever it takes to bring that down. That's one of their goals. Low inflation, maximum employment, and also, of course, making sure that you don't get a too hot economy. But those are the two key mandates from the Federal Reserve. At the moment, inflation is the key point, and they took that 75 basis point hike to 1.75% from 1%. So although, yes, the hope is that at some point inflation will come down, the other impact that having higher interest rates or a bigger rate hike is that, of course, you've got to understand that borrowing costs will start to go up. The dollar has seen a huge amount of strengthening over this time period of monetary policy tightening, and in turn, because of the dollar's overall strength, that we've seen WTI crude oil take a hit. Remember, crude oil. When businesses are buying crude oil, they're buying it in dollars mostly, or most of the time in dollars. So when the dollar is stronger, then you would generally expect that crude oil prices would head lower. Okay, and then of course, on the flip side, if the dollar is weak, then you expect crude oil prices to be stronger, because you need more dollars to buy crude oil instead. So at the moment, as said, crude oil, WTI crude oil, up at around, was that 1%? What happened here? It's now up about so that's about up by 0.8%. The Dixie, or overall measure of the dollar index, is up about by 0.2%. So more or less seeing, the market's not too, more or less flat at the moment. There's nothing too major driving the markets to really push or scare anyone enough to kind of fly away from trading the risk assets or the riskier assets. And also, Powell's has already made his comments yesterday. There was nothing really new that he said. That the only thing that he did say is that the Federal Reserve will do what it takes to bring down inflation. So recession fears. It's if whenever you have a recession, or as we've seen in the past, COVID being the last big the last recession that we've had, when businesses slow down productivity, and when consumer spending drops off, and those businesses don't have demand for their products, and in turn they start producing less, that helps to drive down oil prices, because there'll be less demand for oil if there isn't a lot of production going on. Okay, when of course we're not in a recession, and you can see that productivity is increasing, businesses are are back on the mend or are seeing exponential growth, then you will start to see crude oil start to rise as there is more demand for it. And we've seen that with COVID, when productivity dropped off and we've had, minus 33% for GDP in the US at one point, right? For one of the quarters, that demand for oil was low, and nobody really wanted it because they didn't need it, and because they were, businesses were closed, manufacturers were closed, and they weren't producing anything. So that's one thing to bear in mind with recessionary fears, that could also lead to further downward pressure in WTI crude oil, or crude oil in itself, with those factors weighing in on crude. Gasoline prices and potential tax pause. So the Biden administration has been talking about this for about a month now, of wanting to either pause the gas tax or the gasoline tax for consumers. Now, remember, in the US, the gasoline tax is about 18 cents, is what I've researched, and what has been, of course, is what is known to people in everywhere else. So that potential tax pause, could help alleviate price pressures for consumers, and it could mean that you start seeing gasoline prices start to ease. But this is a problem. So in the short term, okay, prices might be cheaper, but what it does in the long term is that if you have cheaper gasoline prices, when there is a need for energy, gasoline, crude oil, so when there is a huge demand for gasoline because the prices have been rising, in turn what it'll do is it will actually drive up demand if prices are cheaper, and in that case it will also drive up prices even further. So there's pros and cons to having gasoline price or potential tax pause on it. But I think the key thing to remember is, I think overall sentiment is that the Biden administration is trying to ease the oil markets as best as they can, and this action here probably isn't going to do too much. Although yes, it is, it's important and it will do something to a degree. It's not really going to have a strong long-term effect. It's actually going to cause a detriment if there is going to be more demand for cheaper gasoline prices. So there are other things that need to be done more. You probably need businesses, which is what they're trying to do, to talk to businesses, trying not to consider trying to take profit from raising prices, which is something that the Biden administration is quite hot on. But that's one thing to consider as well, as to why we've seen we've seen a mix of upward and downward pressure from the oil markets, and also natural gas markets as well. Then the other thing to consider as well is that refiners, so from the last report that we had from the EIA inventories, is that refiners are already near capacity, or were already near capacity last week at 93.7%. So because of this high demand that there is for oil and other commodities as well, that refiners are trying their best to pump as much energy as they can into the economy, so they can kind of meet demand for those different businesses that require that require crude or gasoline to create those products that provide gasoline to consumers. So that's also one thing to consider, is that businesses are looking to, particularly the Saudis, they've shifted from going from providing more oil to the markets, or saying that there is a need instead for opening up different refineries, okay, or being able to provide the oil that they've pumped more to those countries that require it. So in the US, near enough at near capacity, meaning that they're trying to pump as much as they can into the economy. But that in itself, even though we've got a tight oil market at the moment, still, I think if I was looking at when I was looking at a previous, if I bring up a high time frame chart, the last time we were kind of just put in perspective. So the last time we were below $100 was back in May 10th, or around May 10th. Okay, we were, and then on May 11th we started to move above the $100 barrel mark. So if I just kind of bring that over for you, I'm going to show you that in perspective. There we go. Okay, there we are. So May 10th was the last time we were around, hovering just below $100. And then we've continued to see prices stay above that range, stay above that level there. So one of the things that has been cited by OPEC themselves in the past is that if oil stays above 100 past June into July and through the summer, then there could be some further issues for the oil market, meaning that there may be a need to start increasing production a lot sooner, and maybe a bigger amount is needed. So then investment bank views then to consider. Whoops, go back. So Goldman Sachs, what they mentioned this week is that they say that policy risks are lower. Their $140 barrel prediction for the future, for the 3 months, I should say. And they say one of the things that Commerzbank says as well is that the problem is that this is more likely to support prices by stimulating demand for gasoline. That's in regards to the pause on gasoline tax by the Biden administration, or the potential gasoline tax pause. Again, as I said earlier, that if you lower prices, then you're going to, when there's already high demand for it, you're just going to inflate that and create higher prices instead. Goldman's Curry also said that the pullback in crude prices was likely attributable in part to rising fears of recession. As I kind of said, when productivity falls off, then there is less demand for oil, leading to WTI, or leading to a downward movement in crude oil prices. So they said that the recession, of course, which have hit all asset classes. Then you had Curry that also said that all-time high crack speeds and the difference between the price of a barrel of crude and the products that can be refined from it explains why the focus is on fuel products rather than the crude market itself. So again, how quickly can these companies and oil companies refine that crude oil that has been pumped into the market to be able to provide it to consumers and other businesses that require that fuel? And Curry also mentioned that the administration is very aware of the need to refine more oil, which is why it's targeting products as opposed to the crude. This is an oil refining and product problem as opposed to a crude oil problem. So again, it's not the pumping of more crude oil into the markets. It's getting that refined and turned into an actual product that can be used in the within the economy. And then Citi also gave their view too, saying that given the strong headwinds to growth resulting from both higher prices of commodities and central bank actions, they project the trend line downward in prices through 2023, and in all likelihood beyond that as well. So again, as I said, more or less the cause or the fears of recession as to why we're seeing a bit of a pullback in WTI crude oil itself, off of the back of stronger central bank action from the Federal Reserve to try and rein in inflationary pressures. So, key thing to remember, the Federal Reserve can't control prices for gas. okay, or crude oil. They can't do that. All they can do is hike rates, low rates, or keep rates unchanged, provide QE, or bring in quantitative tightening to the economy. And then it's down to the businesses themselves and what the government kind of does to try and alleviate any sort of pressures or try and help consumers out within the economy. So that's a key thing to remember. Again, the recessionary fears is about the loss of productivity from what a recession can do. So we've got about 4 minutes. Let's play the video of the last release, and then we'll get to the market. Hopefully we get to see the reaction today, or we actually get to see a release. Okay. See. Oh yeah, so I remembered I had it on the daily chart. But what we did see is that there was an initial move down from the bigger build in the inventories, and then we'd seen that move back towards the upside. Got about 3 minutes still, so I think if it's going to be delayed, I'm not going to get too much of a reaction. So we'd seen about 44 ticks towards the downside initially from WTI, from crude oil there. And then deviation wise, as said, what we've seen in the past, of course, you can kind of see there. I was going to show you in a separate window, but what we could see is that in the past, when we were trying to hit that 4 million or 5 million deviation as to what we're expecting, when we're getting close to that there, we'd seen a bit more of a reaction from WTI crude oil. Okay. So both times of the last 2 weeks, what we've seen is that we've seen a mix of data. So we've seen an overall build last time and the week before that, and we saw more or less a quick reaction to the release, and then the markets kind of carried on in the way that they were going. So 39 ticks beforehand on the 8th of June, and then about 44 ticks towards the downside. Kind of keep going ahead a little bit. Oops. Yeah, okay. And then after about 10 minutes or so, I'll keep this window open just there. Mm. Yeah, okay. All right. So it's going to be delayed indefinitely. I don't think we're not going to get this data. Should have actually seen that earlier on, about 12 minutes ago, during the stream. Okay, so no EIA inventories are being released today. Kind of keep an eye on it for you. Yeah, if this ain't happening. All right. Well, thank you for joining me so far, and watching, going through the preparation for the EIA inventories. I think one thing to consider then, I'll just go through the deviations with you anyways, seeing as we've got a little bit more time to kind of talk through it. So the deviations then what we had, so we had seen looking for, I think we're still looking for about 5 million deviation to get a stronger move from the markets. We didn't get that last week on the headline figure itself. And then we look for the other bits of data to move in the same direction. We didn't get that last week. We'd seen about 44 ticks down initially, and then about 20 ticks was the upside. And after about 10 minutes, then we were down by 120 ticks, or about $1.20. So initial move wasn't as strong as we'd seen here with previous releases. But I think if it does come out, if the data does come out and I'm not streaming, then just be aware that was our trigger, basically. Looking for a deviation from the forecast figure with the actual figure, about 5 million on the headline figure itself, and then the other bits of data to move in the same direction as well, rather than having a bit of a mixed bit of data here. So that's what we were expecting. I think I'm going to call it an end to the stream there. We're not going to get this data here. So apologies. Hey, it's out of my control, but as I said, I thought it'd be useful anyway to kind of give you a bit of information as to what to expect. Fitz Bowman saying a lot of stuff. Okay, well, interestingly, he said that another 75 base point rate hike would be appropriate in July, and hikes of at least 50 base points in the next few subsequent meetings. Dixie didn't do too much, neither did the S&P 500. Markets are more or less expecting the Fed to do whatever now. Maybe even 100 base point hike. Powell didn't say no to that in his testimony yesterday, or neither did he say yes, but left it up in the air, really. So whatever it takes, or the ECB mantra or Lagarde mantra, do whatever it takes. Okay, all right. Thank you very much. Yeah, that's kind of sucks. We don't get any data. More comments. Vigilante says, thank you. Just discovered these streams, very informative. So will you put out the daily sentiment updates into consideration? That's something that I will consider. Seeing how, let me have a look and consider how I do that and what I do with it for you guys. Can this information put things into perspective when trading for a prop firm? And what does Financial Juice Terminal Pro cover on the daily basis? Yeah, so Financial Juice itself, we might as well do a bit of an ad spin here. That's the one thing I was going to go through here. So Financial Juice, it's a key thing is that investment banks, they use it as a way to manage the risk and then capitalize on potential trades as well. Now, the key thing to consider is that if you're new to a Squawk service or live voice and text feed or text service, then you'll notice on our site we've got a voice news here and a news feed here of all the text headlines that are coming through. Key thing is as said, a lot of traders, what they do and what they've said is that they manage their risk, or they use the news to manage their risk or to capitalize on potential trades. So again, so one thing to consider as well with Financial Juice Pro, if you're familiar with it already, if you're on the light version, with the Pro version, you don't get any delays, you don't get any adverts playing, and you also get live real-time data as well here, appearing on the left-hand side of the calendar. So one thing to remember as well, you can also set your own economic triggers for releases. Of course, ignore this bit here where it says minus 1.5. That's just what the forecast is, not what we're telling you to put the buy or sell alert as. You can put that in whatever you want. If you wanted to kind of chop and change with a buy or sell, you can, let's say I'm looking for minus 4.5. Okay, and I save that there. Let's put in buy. Let's do 5.5 mil. Okay, if I buy, let's do 3.45 or minus 3.45. Let's do that. So I'll put that, so that trigger is set there for you. when the release comes out with a figure, then it'll come out in real time with the, if it hits your trigger that you've set yourself manually, then it will either come with a buy or sell signal there for you, depending on how you set your triggers. But that's also in real time as well. So Financial Juice, there is a 7-day free trial of that there that you can use for yourself. And although I did want to show Tick Strike in real time and show that action happening, but what Tick Strike does, it allows you to listen to order flow within the market. Okay, so imagine you're on the Chicago exchange. If you were, let's say go back in the 80s when all the guys and gals were standing there in the pit and they were shouting buy, 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 sell, 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 buy 120, and then some guy or some lady next to them gets in at a better price, or takes up a position against the other person, and they start spitting at each other or nudge each other, or get towards a physical interaction or physical fight, or could happen, then that sound that you hear within the trading pits is translated into Tick Strike here with a visual and audible alert. Now here you can adjust your sensitivity. So 1 is the most sensitive, with 15 being the least sensitive. So if you set it on 1 or if you set it as the most sensitive or very sensitive, then what it'll do is it'll kind of alert you to the moves that are happening within the markets, whether there's a bit of buying or selling going on. If it meets the trigger, then it will set off crude oil here, or the little Tick Strike here for you. Okay, so you can see there's a bit of buying going on and Tick Strike is going up. So if you were to decrease the level of sensitivity, so 15 is the lowest level of sensitivity. Only when there's big moves in the markets, only then will Tick Strike show you the alert and go off. Okay, so Tick Strike, you can also have a one thing we want to do. Key thing is we'll want to give you a 7-day free trial of that as well, which is there. The comment section that you can use and have a look at. The key thing to remember is that a lot of traders sometimes, if you're a scalper, you're a day trader, then Tick Strike can be useful in that way. Of course, there isn't one way to use Tick Strike, but as I kind of mentioned with Financial Juice Pro and the voice and text feed, is that a lot of traders, they use Tick Strike to manage their risk, capitalize on potential momentum that's happening within the markets, and maybe scalp that. But again, it's all down to you how you want to use it as well, whether or not it works for you. So there's a plethora of different products, different assets that we cover in instruments. So, your commodities, your currencies, your stocks, your ETFs, ETNs, cryptos as well. Okay. That's what we cover with Tick Strike. So as I said, 7-day free trial is there for you to use as well. Is it user friendly for day traders? So mainly from what we've seen, that day traders have been using it, the most with Tick Strike. Again, it's more about showing you the momentum that's going on within the asset or within the markets overall. So let's bring this over. So as you can see, if we're looking at the S&P, the NASDAQ, that we can kind of see there's some buying going on. There's a buying momentum. Again, take that how you will, use it how you want to use it. Again, experiment with it. That 7-day free trial is there for you to have a little try out of it. Also, a reminder, if you did like the video that we did today, then don't forget to, of course, like the video, subscribe to the channel, and also follow us on Twitter as well. So that link is there for our Twitter. You can follow us there. And then the deviations that I was showing you here today as well. So this information, of course, if you want more time to kind of delve into it and look into and kind of gauge what your strategy could be that you make yourself, then you can look at the historical data of what the release was, what the deviation was, and how the markets. Sorry, I'm just kind of keeping an eye on the inventories data itself. Then you can kind of gauge how the market could react and whether what kind of plan you want to make yourself to depending on how the data had affected. Okay, Powell said, I would be reluctant to cut rates. I think that's more of a given, really, at this stage. Okay, so yeah, so deviations, this is something that if you're subscribed to our mailing list, you have access to, and you'll be able to look at in more detail about how the markets have reacted in the past to certain releases. So that's also a link there to sign up to the mailing list. But also what MacroAce does is we provide you with the week ahead of what to expect. Okay, so this is what I sent out on Sunday of what to expect in Asia and Europe, in the US, and summary of the weekend news. So you can kind of prepare yourself for, as I said, what to expect for the week ahead. And here I show, the times of when the releases that we'll be covering them, when those live streams begin, to highlight what's the most important release to be aware of during the week. So that, as said, is an email that I send every Sunday once. I only send that once a week. I don't send any other links or those emails. It's too much. And also provide you with the upcoming videos or live streams and previous live streams that we've done in the past as well, for you to be able to have a look at as well. Okay. Alrighty. Thank you very much, ladies and gentlemen. We'll conclude the live stream there, and I will see you next week, or unless EI Inventories appears, then I'll start a live stream video. We'll see. All right, take care. Bye now.